The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Apple under pressure and the EU in the crosshairs. Fresh brinkmanship on global trade stirring up fresh selling of U.S. assets. Live from Studio 2 at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Alex Steele. We're kicking you off to the closing bell here in the U.S. And guess what?
What?
Stocks are off the lows.
They are off the lows, Alex Steele, but they're still in the red.
They are still in the red, down about 0.4%. At one point, U.S. stocks falling the most since the beginning of April. We are, though, sitting right around that 200-day moving average, so watching that level. Other asset class to pay attention to here, you're looking at tech trading heavy along with Apple. We'll get to that in a moment. But the 30-year yield, looking at the bond market, surprising we're not seeing more of that sell-off after this week's price action. But Romaine, the one thing that is continuing selling off is the dollar. We're now at the lowest level since December of 2023.
Yeah, that's pretty significant here. Remember, we had a couple of weeks of peace in the trade war, but the president woke up this morning and, well, he got himself that gun. While lacking details, the contours of Trump's EU threat suggest a bumped up reciprocal tariff of 50% on European goods. A missive, of course, that he posted to social media just ahead of a meeting between the U.S. and EU trade chiefs.
I think the president was getting frustrated with the EU. You know, the problem with EU, I've said several times, they have a collective action problem. There are 27 countries. They all have different needs. The Germans, they are interested in cars, the French in agriculture. And then you have Brussels negotiating with them.
Now, we started the day with Treasury yields a half percentage point higher than where they were on Liberation Day and the dollar 4% lower. Now, while yields are holding up today, largely because Treasury Secretary Bessent promised regulators were actually very close to loosening constraints on banks, the greenback did continue its slide, now at its weakest level since 2023, as the capital flight does continue specifically because of those trade concerns. Now, all told, benchmark equity indexes are off the lows of the day, but they are set to log a fourth day of losses and another week of underperformance relative to the rest of the world. Apple, by far the biggest drag after a separate missive by Trump that threatened 25% tariffs on iPhones if Tim Cook doesn't move production back to the U.S. Apple, Alex, now the worst performing major tech stock since April 2nd.
Yep, and it seems like President Trump lumping in Samsung to that as well. So take a look at what Apple has done and what it could do, and therein sort of lies the issue. This is a chart from Bloomberg Intelligence that shows that Apple suppliers can actually double production capacity in India by 2026 to up to 80 million units. And you can see what they've done over the last few years, increasing production in India, taking it out of production in China. Bloomberg News has reported that Apple could double that production in that South Asian nation. Now, if you're taxed, does it change the calculus? And how quickly can you move that production to the United States?
That is the question. And we kick things off right now with Tom Forte, Managing Director and Senior Consumer Internet Analyst at Maxim Group. He's got a hold rating on Apple. And I want to start there. I mean, we all know, Tom, that it's unrealistic that they're going to be able to move production back to the U.S. en masse anytime soon. So now the calculus really becomes that if Trump does follow through with tariffs on iPhones, what ends up being the potential hit to Apple's bottom line?
Yeah, so Romaine, the way I look at it is we're in the middle of a trade negotiation between the Trump administration and Apple. So I think what's the ultimate outcome? It could be having Apple increase its commitment for investment spending in the U.S. behind the $500 billion today. So I'm not convinced yet that we'll see iPhone production or iPhone assembly in the U.S. I think what you've seen is what the administration's offering to Apple and to essentially every corporation is lower corporate tax rates. And then they granted kind of short-term relief on tariffs for both smartphones and computers. Apple, for its part, is ramping its investment in the U.S., including across multiple states. So I'm not convinced yet we'll see iPhones assembled in the U.S. It could just be a higher commitment than the $500 billion.
This gets to the idea, though, too, as to how much, I guess, whatever happens in the interim ends up becoming a problem for investors in Apple. Even if there is maybe some negotiation, some move, there's now clearly just this threat that's hanging over Apple, and for that matter, probably a lot of other companies as well. But for whatever reason, Apple is now in the crosshairs. And I'm just curious as to, as an analyst, how you even model something that, to a certain extent, isn't really even modelable.
So you think about the comments that the company made in the March quarter where they talked about a $900 million impact in the June quarter from tariffs. So that gave us an opportunity to quantify how could tariffs negatively impact Apple's profits? It is challenging. So you look at, for example, Apple gets about 15% of its revenue to selling products to consumers in China. That revenue's been under pressure, down double digits in the December quarter, down single digits in the March quarter. That could continue to be under pressure. So I think ultimately we're trying to figure out, how does this impact sales? How does this impact profitability? Apple, for its part, gave us that $900 million number for the June quarter. So we have a slight sense of how this is affecting Apple.
So the stock is down 3%. The company also has $132 billion worth of cash and cash equivalents. Like, why are we putting a risk premium on Apple here? Like, they can clearly eat the issue.
The risk premium on Apple is that they're over-dependent on China from a supply chain standpoint. And then, like I said before, they're getting about 15% of the revenue selling to consumers in China. And I think what's new about today's news, or it follows up on earlier comments, that simply moving production to India from China may not be good enough. So again, I don't know if that means that the ultimate outcome is a US-made iPhone, but I think, again, that for Apple, clearly there could be more pressure on profitability in this trade war scenario.
In the news conference and executive order signing that President Trump just had, he also included Samsung, because he got a question and he was like, why are you, the reporter said, why are you going to punish U.S. companies? He's like, I'm not. I'm also going to put Samsung on the list as well. Would that level the playing field?
So it may level the playing field between Samsung and Apple. So again, when trying to determine President Trump's motives here, he's clearly trying to shrink the trade deficit, shrink the budget deficit, and bring some manufacturing back to the U.S. I think his primary concern relates to chips and security, cybersecurity, and then secondarily pharma and having a more secure pharma supply chain. So it isn't clear to me ultimately how this plays out. But yes, perhaps if Samsung and Apple are in the same boat, that levels the playing field. Then it's just challenging for consumer electronic companies in general.
All right, Tom, I really appreciate you taking time for us today. Of course, all eyes right now on that stock, down about 3%, and who knows what next week may hold. Tom Forte is Managing Director and Senior Consumer Internet Analyst at Maxim Group, as we keep an eye on the markets and we keep an eye on the economy. And we're going to get a bird's eye view of that and the economic toll of the tariffs with Daniel Hornung, former Deputy Director of the National Economic Council. And then we're going to take a closer look at the impact on the luxury sector, specifically with the former chairman of LVMH's North American business, Pauline Brown. Stick around. This is The Close on Bloomberg.
I think we were in the middle of, as I talk to industry, this U.S. innovation edge. We are starting to see real productivity increases like no other country is. I'm expecting that by, certainly by this time next year, we will be north of 3, and that we will be turning the corner toward the end of the year.
U.S. Treasury Secretary Scott Bessent with Wall Street Week's David Weston talking earlier today, weighing in on that 3% growth target here in the U.S. Joining us now to discuss is Daniel Hornung, former Deputy Director of the National Economic Council and currently a Senior Fellow at MIT. Really good to get your perspective here, Daniel. Thank you so much for coming in. Okay, what would be a scenario where we could get 3% growth?
Well, it's great to be with you. If we want to get 3% growth, one of the first things we probably would need to do is reduce some of the very clear risks to the outlook that are detracting from growth. So I think the most obvious one is the tariff threat. I think before today might have said that there were reduced recession risks associated with trade policy. Mm-hmm. But the announcement today, I think, clouds that picture again. There are a number of other risks on the horizon. The moves in long-term interest rates, those going higher because of concerns about the fiscal outlook. That also makes it, I think, harder to see us getting to 3% growth because of the effect of that of kind of crowding out private investment. So, I think there are a range of things that you would need to do, but you need to start by doing no harm.
Well, the twofer, though, is going to be lower taxes. Well, threefer, lower taxes, deregulation, and forcing companies to produce here. I mean, I was going to say motivating companies, but maybe Apple might have a different way of describing it. If that kind of scenario plays out, does that have the chance to get us there?
Well, I mean, let's take those in turn. You start with the tariffs. And again, the tariffs today going from kind of a 15% effective tariff rate to something like a 20% effective tariff rate. That's contractionary, but it also creates a lot of uncertainty, as we've just seen that effective tariff rate jump around really dramatically from less than 3% before the president came to office to above 25% at Liberation Day and now back and forth some. So, that's a real concern. And then when you go to the tax cuts, I think one thing that has not been understood well enough here is just the degree to which the bill that the House passed this week is both highly regressive and highly fiscally irresponsible. And those are both things that could weigh on growth to some degree. So if you look at the regressivity, the fact that because of the Medicaid cuts and because of the cuts to food assistance, a range of analyses have found that incomes for households making below $50,000 a year will actually go down. So that is not positive for the economy, particularly if we're heading into a period where recession risks are elevated. And then the second thing is the large deficit increases in that bill, in the range of $3 trillion, have a real risk of taking long-term interest rates higher, and that would weigh on growth as well.
I am curious, though, Daniel, and particularly when it comes to this budget reconciliation bill. And it's interesting that we talk about this idea of providing these tax cuts in the same bill where we're also, of course, pulling back some of the safety mechanisms for the lower income folks. You were at the National Economic Council around the time the IRA was working its way through the White House and Congress, as well as some of the other fiscal measures. And I am curious as to, is this just simply taking us back to maybe where we were 4, 8, even 16 years ago? Or is it really that regressive that it's taking us back to a time that most of us alive have never seen?
Well, in terms of this legislation itself, it is, I think, rare to see the combination of increases to the deficit while at the same time having a negative impact on low-income people. If you look at the 2017 law, for example, it was a large deficit increase. But, if you look at the distribution, middle class and lower income people did see tax cuts. Now, they were smaller both in percentage terms and dollar terms than the tax cuts at the top. But the thing that I think is so unusual about this legislation is that you're seeing reductions in after-tax and transfer income for people making less than $50,000 a year, while you're still seeing those large deficit increases. And I think that's of significant concern. And there are a number of Republicans in the Senate who've expressed concern both about the regressivity in the form of those Medicaid and food assistance reductions, but have also voiced concern about the deficit concern. So I think it will be interesting to see how that plays out in the weeks ahead.
Well, but just to play devil's advocate, and I don't necessarily, these aren't my personal opinions, but the argument that a lot of the Republicans have made is that some of the regressiveness that we're seeing, particularly when it comes to Medicaid and some of the other programs, is sort of making sure that undocumented immigrants aren't on those rolls, making sure that able-bodied Americans who may be on Medicaid and some of these programs aren't on those rolls. The idea, again, their argument that they're not really throwing people off of it wholesale, but just people, in their view, that shouldn't have been on it in the first place.
Well, the Nonpartisan Congressional Budget Office, which is not a Democrat or Republican outfit, would strongly disagree with that statement. Their analysis that roughly 10 million people would lose their health insurance coverage who are currently on Medicaid, the vast, vast majority of whom are U.S. citizens. An additional 4 million or so lose their Affordable Care Act coverage. So we really are talking here about policies that largely would reduce health care coverage and food assistance for Americans of lower and moderate means. And of course, these are some of the same constituencies that President Trump really ran on improving the material economic conditions of.
Daniel, before we let you go, a few weeks ago, everyone's base case was stagflation, maybe recession. How would you categorize the economy for the rest of the year?
Well, if you had asked me that question yesterday, I think I would have said there are much lower recession risks than there were 2 weeks ago or before President Trump paused the China tariffs. I think those are those have moved higher again, not quite to where they were post-Liberation Day, but they have moved higher. And I think that really just speaks to the uncertainty that we're seeing here, where the tariff rate really has whipsawed all the way around. It's hard to understand what's going to happen in the economy, how to invest as a business. So my hope would be that we can get some of that uncertainty down again, recession risks come down somewhat with it.
All right, Daniel, really appreciate you taking time for us. Daniel Hornung, right now, is a former deputy director of the National Economic Council and now a fellow over at MIT. A closer look at the potential economic fallout here from some of the latest developments coming out of the Trump administration. We're going to go back and talk about the broader markets in just a second, but I want to bring your attention real quickly to Informatica. This is the software company. The shares halted right now after spiking more than 20% here. A red headline crossing the Bloomberg terminal. Salesforce said to be in talks to acquire Informatica. We're going to get you some more details on that in just a minute. When we come back after the break, though, we are going to take a look at the broader market here off the lows of the day, but still heading for a fourth straight day of declines. We're going to get a read on investor sentiment with Anthony Saglimbene, the chief market strategist at Ameriprise Financial. This is The Close on Bloomberg.
I think we are very close to moving the supplementary leverage ratio, SLR. That is moving along very quickly between the three banking regulators, the Fed, the OCC, and the FDIC. So I would think we could see something on that over the summer.
And that was the Treasury Secretary of the United States talking about the SLR. Basically, this is a kind of capital rules on banks right now, at least for those that are in the Treasury market, that could potentially be loosened, at least according to what we heard from Besant just there here, saying that they're actually very close to a deal in loosening those regulations. That had a big impact actually in the yield space early today, and that's one reason why yields have remained lower, despite the fact that you are seeing a drift lower in stocks on the day. Here to talk about market sentiment is Anthony Saglimbene, chief market strategist at Ameriprise Financial. And Anthony, I mean, I'm not quite sure if this is we should call this a turn in sentiment. We should sort of, add the asterisk that volume is low this week as we head into a holiday. But I am curious as to what you make of kind of I guess, let's just say the rally being put on pause over the last few days.
Yeah, I mean, you pointed out, and some of your guests, your previous guests, I think did a really good job of just talking about the degree of uncertainty that remains in the market. Tariffs, impacts on company profits, growth, inflation. We've walked back from the abyss of those early April lows, and we've recovered all of that. But I think we're at a point now where markets need to consolidate, digest some of the really big volatility spikes that we've had over recent weeks, and then just take an assessment of what's to come. Obviously, today's social posts from the president on Apple and on the European Union don't really build a lot of confidence in where the tariff situation stands right now.
And that was, of course, my first reaction, too. I mean, we had kind of had, I guess, relative calm over the last couple of weeks, of course, at first after they sort of reached that détente with China. But this was a reminder here that these issues are still unresolved, and the president at any moment could wake up and stir it back up. So as an investor, as someone who's trying to sort of figure out where people allocate, how people stay invested, is this still a market where you want to be defensive, or do you see opportunities to maybe add risk?
Yeah, you definitely want to be balanced. One of the things that we've been talking about in the downturn and then when markets rebounded is kind of maintaining a healthy balance between equity and fixed income and alternatives. I think at levels right now in the stock market, the S&P 500 is trading at about 22 times this year's earnings. That's not cheap. And so moving forward, we need to see companies deliver on their earnings expectations, even though we've seen Q2 and Q3 earnings expectations come back a little bit. So I think moving forward, investors want to stay a little bit defensive. They want look at opportunities that kind of generate within the technology space. And as a whole, for your equity portfolio, focus on companies that have visible earning streams, paying dividends, and have stable balance sheets. And you can find those companies in financials and some of the industrials. And when we do get pullbacks in areas like technology, use that as an opportunity for long-term secular growth and take advantage of some of those potential declines.
Talking about finding the yield, does that mean that you want to be buying the long end of the Treasury market? Scott Bessent, Treasury Secretary, said just that. He was like, you know what? Go ahead. We should see more buying by U.S. citizens as well as people within the country. What do you think?
Yeah, I mean, obviously, with some of the news coming out of, Moody's downgrade over the weekend and some of the reaction that we've seen in government bonds, and then obviously the reconciliation bill that's causing some concerns around deficits. I don't know if we would be exactly comfortable extending duration to the max, say the 30-year, but I say somewhere between 5 and 10 years, looking at that intermediate range, you're getting paid very well on U.S. Treasuries. They're still the safest asset out there. They still are a diversifier within the portfolio. So that intermediate term range, 5 to 10 years, I think you can take advantage, particularly if you've had cash sitting on the sidelines earning 5% in a money market. I would be extending some of that duration, and I think government bonds and high quality investment grade is the place to do it.
So is the U.S. exceptionalism trade around? It's just not the shining star it once was, if we take a look across U.S. assets like the dollar as well?
Yeah, I just think there's a lot of uncertainty right now. I think tariffs are complicating the operating environment for businesses, consumers, governments. And so it makes it very hard to look out over the next couple quarters and say, hey, the U.S. economy is going to continue to be on this trajectory of growth, which means corporate profits are going to continue to grow. So I can be confident in investing in the market, or as a CEO, making investments in capital expenditures. I think right now we're in a period where there's just a lot of uncertainty. I think consumers and businesses and governments are going to start sitting on their hands if we don't know what the rules of the road are. And today's examples of President Trump, putting potential tariffs on smartphones like Apple's iPhone or on the EU, it just sows more seeds of uncertainty, which I think could derail at least a lot of optimism in where growth is going over the next couple quarters. And I think that's why you're seeing markets stall a little bit.
All right, Anthony, thanks a lot. Really appreciate it. Anthony Saglimbene, Chief Market Strategist at Ameriprise Financial. Thank you very much. Well, President Donald Trump just signing executive orders to accelerate the construction of nuclear power plants. The CEO of nuclear power startup Oklo was in the room for the signings. That stock is up 26%. He's going to be joining us next. This is The Close on Bloomberg.
Taking a look at shares of U.S. Steel, ticker X, those shares halted right now if the President of the United States has confirmed reports that Nippon Steel and U.S. Steel will operate in a partnership. The President posting on Truth Social that he did receive a recommendation from CFIUS, that is the organization that effectively reviews national security concerns with regards to foreign companies buying U.S. companies. He said that U.S. Steel will remain an American company. There will not be a purchase, but there will be a partnership, and the bulk of the investment will come in the next 14 months. Trump also said that his tariff policies will ensure that steel will be made in the U.S. forever. And he also plans, Alex, to hold a U.S. Steel rally on May 30th.
Yeah, very significant. We'll follow those headlines as they come. Well, staying in D.C., President Donald Trump signing 4 executive orders aimed at expanding the production of nuclear energy. Oklo CEO Jacob DeWitte was there at the signing, and he joins us now from the White House. Oklo is a nuclear startup, basically trying to push hard into that field. Jacob, how did your job just become easier as of an hour ago?
A couple ways. Thanks for having me. I think it's a pretty exciting moment, honestly, for American nuclear technology and American nuclear industry. It unlocks a couple things, right? It moves forward modernizing regulatory procedures and processes so that we can actually get them right in an efficient way. I think that's a big unlock because there's a lot of sclerosis and a lot of frankly, inefficiencies baked in the process. We're really excited about what that does. It opens up more and alternative regulatory pathways for doing things Department of Energy and Department of Defense sites. It moves forward some of the commercial opportunities and accelerates those in terms of being able to provide power for security. And it opens up supply chains for fuel. That's one of the biggest accelerants for us.
Okay, well, let's get to that, because part of the issue with nuclear in part is the cost. It's just so expensive to build a new plant. Expanding or keeping a plant running is one thing, building a new one something else, and small modular reactors it's still unproven in terms of its efficiencies to scale as well as cost. How does this help that?
Yeah, I mean, the thing to me that sticks out is the actual cost drivers in a nuclear system, really compared to all energy sources. And what I mean by that is, to me, the best fundamental metric is the actual energy efficiency, or really the material efficiency to make energy from these systems. In other words, how many pounds or kilograms of steel, copper, concrete, fuel, et cetera, are needed per megawatt hour of energy produced. And nuclear requires the least by far. That means it should be the cheapest source of energy. It's some of these inefficiencies from a regulatory perspective, from kind of old, outdated requirements and processes that have slowed these things down from a commercial development and sort of iteration process to sort of unfold and actually tap into that economic potential. These things will help modernize and accelerate how we can do that and realize that. Because look, if you need the fewest materials to make what your product is, you inherently have a cost advantage. And so I think nuclear is well positioned to frankly be one of, if not the cheapest source and most scalable source of energy that we have. We've seen teasers of this. We've seen it work really well in other countries who've been able to continually build without this kind of regulatory decay. We're about to see that unlock in the US, I think.
And just want to point out for our viewers, just in terms of the actual provisions, the contours of this executive order. We knew, of course, last year, I think it was Joe Biden had proposed trying to triple nuclear capacity by 2050. Now, this new executive order by Trump would actually quadruple it by 2030. And that includes provisions to ensure 10 large conventional reactors are under construction by that time. Where's the money going to come from?
Yeah, I think this is what's really exciting about now. We've seen this gradual buildup of support from President Bush to Obama to President Trump to President Biden to President Trump again, of this continual escalation of support for nuclear because of its importance for energy abundance and all of those pieces. And I think what we see happening here is the market wants power now in a way that's never been clear. As we reshore jobs, as we drive electrification, as we think about how we want clean power to drive all the things we want to do here, and this massive piece that from power demand perspective that AI provides. So the money is going to come from the private markets, from the capital markets. We've already seen record capital inflows from investors, from strategic investors, from companies, from customers across the board into projects, things like what we're doing, things like some of our peers and competitors are doing that are going to drive these things forward. And I just have to say, this is like a real testament to a vision of frankly, the president has, Secretary Burgum has, Secretary Wright has on energy dominance. It's about unleashing the nuclear innovation ecosystem in the U.S. to actually start deploying. And it builds on great bipartisan wins in the past, including, for example, the Advance Act that last Congress and President Biden signed. So it's a pretty exciting time to see how these things are going to be moving forward. And the steps taken in a holistic approach today by the president really are going to supercharge this.
One other provision in this that I think is interesting, of course, the first of these, at least according to the executive order, will be on military installations. And I guess part of that is to get around some of the regulatory constraints that I think you were referring to a little bit earlier. Does that matter, the location of them, if they are on military, effectively on military bases? Does that matter about its commercial application?
I think it does, yes, in a couple of ways. For one, that's going to be an important opportunity from a national security perspective, as well as a market opportunity, right, to provide clean, resilient, reliable, affordable power that offers significant sort of energy security benefits on bases, both domestically and potentially even some cases internationally. We need critical infrastructure to have the power that it relies on at our military, bases around the country and abroad. And so opening up pathways to actually accelerate the deployment of nuclear technologies to be able to provide that power is critically important. And one of the reasons that nuclear is so resilient is you can put a lot of fuel in a single system that can run for a long time. In other words, when you load up a reactor with fuel, it might run for years, even a decade or more, without needing to refuel. So it's quite resilient against supply chain disruptions. You just can't do that with any other energy source. Renewables obviously aren't reliable enough, and fossil fuels, you need to constantly bring in, fuel replacements. And that's just a testament to the incredible energy density of nuclear.
Jacob, is the time frame good enough? The tax credits, you can take effect with them as long as you begin construction by the end of 2028. That's not that far away for something like nuclear.
It's not that far.
Can
I know.
Work?
I mean, I think I think it's a great question. I mean, I think we're hopeful, obviously, that those kind of the benefits and the importance of what the tax credits enable in terms of scaling initial technologies forward and drawing in capital to then become self-sustaining is important. Look, there's a natural expiration for those things. That makes perfect sense. But we need to also recognize the window of time which they can be most useful. We're positioned to benefit from that and be able to, use those in a good way. And honestly, the actions done by these EOs actually help accelerate the timeframes to be able to actually take, some of those credits into play. But honestly, I think there's a lot of opportunity to think about how you can move those to be more complementary to the EO sign today and even more accelerative. So, we'll watch how things kind of continue to progress in Congress, but there's still a lot of opportunity to sort of combine policy angles of permitting reform, of kickstarting and supercharging supply chains, and bringing to bear capital incentives to drive those private capital inflows and accelerate them to build more and more nuclear plants and all of the benefits that unleashes in the country.
All right, Jacob. Well, certainly exciting times for you, and based on the share price reaction, exciting time for investors. The CEO of Oklo, Jacob DeWitte, there, fresh off the signing of that executive order in the White House, effectively a measure by the President of the United States to try to accelerate the construction of nuclear power plants here in the United States. Alex?
All right, well, today, President Trump also threatening to put 50% tariffs on European goods. Citi now estimating the tariffs, if fully implemented, could cause the stock 600 index to fall 7 to 8% from these levels. Joining us now to discuss is Pauline Brown, former LVMH chairman of North America. We are so excited to talk to you. There's so much to get through. What's your reaction as the former LVMH CEO for North America hearing about these potential tariffs?
It's a disaster. And it's a disaster not just because it's going to exact a very heavy price on an already very heavily priced set of goods, but because the industry has so many headwinds that it's already grappling with. Headwinds in the wholesale market, headwinds in the macroeconomic, headwinds in the saturation of brands, the fact that for the last few years they've been competing very aggressively and taking price way too high. So this move, if it comes through, will have a huge effect on many of the European houses.
This is a silly question, but I think Europe, I think luxury, I think pricing power. Is it not that easy to make that case?
Well, historically it has been. And for certain brands, I'd say I could count them on 1 to 2 hands, like in Hermes, there seems to be no ceiling. But for the majority of them, I think that they have taken it too far too fast. So if you look at many of the Chanel bags, the same bags that were on the market 5-6 years ago, pre-pandemic, they were priced at about half of what they are today. So there was a period of time where particularly the American consumer seemed unstoppable. During the pandemic, that American consumer wasn't spending and couldn't spend on experiences. So there was sort of a diversion to stuff, to beautiful stuff. And that has balanced out since. And I also think the industry just was investing a lot in expanding its footprint, in reaching new customers in second-tier cities, in going from ultra-affluent to aspirational. And those aspirational consumers who still have money but don't have unlimited money, they're probably the most sensitive to those price issues.
I know the U.S. is an important market, but this is still a pretty broad company in terms of LVMH, and even for some of the other luxury competitors in that European luxury competitors in that space. And I am curious as to what optionality there is to make up any potential deficit in U.S. sales around the rest of the world, particularly at a time when we're talking about a global economy that might be slowing, a Chinese consumer that might be retrenching. What is that option right now?
Well, if you would have asked me the question back in, say, 2008, where we had our economic crisis in this country and China was really just beginning its enormous run-up, I would have said there were still some big swaths of the population that were untapped. The reality is, if you look at the growth of, in particular, LVMH, but I would say to a lesser extent, Kering and Richemont and Prada and all the other consolidated players in that group, in that sector, they have covered a lot of territory. They've opened a lot of stores. The markets that were considered underdeveloped just 10, 15 years ago are now highly developed and much more discriminating. So I don't think that there's any white space in terms of geography, or not much. And the question then is there white space in terms of categories? Well, LVMH is trying to move into hospitality, for example. They're opening a hotel under the Vuitton brand. But that's a different business. It has a different return. a different competency that's required. And so it may have a halo effect on sales of handbags for Vuitton, but I don't know that that's going to be a big frontier for them.
Yeah.
I think this is going to be a tough stretch.
It could be. I mean, we should always kind of put the asterisk, too, that nothing is in place yet. And we know the U.S. president is always open to negotiations. And I am curious about the personalities involved with this. Bernard Arnault was just here in the United States, and he was very vocal here about the European Union trying to make some concessions, even pushing on Emmanuel Macron in France, saying, look, we need to sort something out. We know, at least publicly, he has had a very, very long relationship with Donald Trump long before he became president. And I am curious if, Bernard, does he have, I guess, the charm and I guess more importantly, the diplomacy skills to maybe sort of get them to back off?
Well, he certainly has leverage in Europe, although not as much leverage today as a year or two ago. The company has dipped below the fifth largest in the continent. It was number one for a good while. But it's still a very big company. It's still a very important company. And he still represents an important figurehead of European business. His only real leverage in this conversation, though, which he is using, as I hear, in the EU, is that he'll just open more factories in the U.S. if the EU and the U.S. can't come up with a better trade agreement. The problem with that, call it a threat or a alternative, is that in past years, when Bernard has tried to set up manufacturing capabilities here in the U.S., there is some Vuitton production in Texas, there's some in California. It has not been up to par. He hasn't been able to get the workers. He hasn't been able to get the quality control, hasn't been able to get the costs down to what he can actually do in his home region. So it thus far hasn't proved to be a viable alternative strategy. But I'm sure he's going to work whatever angles he has and he can.
It would be weird, like LVMH made in the USA. I don't know if that, I don't know. Maybe I'm just a little biased on that. Pauline, before we let you go, we know that luxury is really struggling, certain areas of luxury. What's working really well right now? And does that surprise you?
Well, yesterday, Ralph Lauren came out with their results. And while they were cautious for the rest of the year, they beat expectations for the quarter. And they actually had very robust performance, and not just in their home market, U.S., but even in markets that nobody seems to be doing all that well, like China. They were up double digits in China, high teens. So what do I think explains that? Well, I would say two things. Number one, there is a bit of a trading down effect. So a big portion of Ralph Lauren's business is not ultra luxe. They have their purple label, but that's a small percentage. They also have about 200 outlets here in the U.S., so they have a huge discount business that it balances out their portfolio. And I think there's a perception of value, which now some of the other more traditional luxury brands are losing. So they have been doing well. Tapestry, for similar reasons as Ralph, has been outperforming. And then among the pure luxury, Hermes is always going to be a standout. It's just a very clean business, very disciplined, and has such a loyal and price and sensitive customer base that keeps coming back.
All right, Pauline, we have to leave it there. This was a really illuminating conversation, and we got to get you back to talk about this a lot more, particularly once things die down just a bit. Pauline Brown there is the former LVMH chairman of North America. Here, Alex, I don't know, are you ultra luxury or are you aspirational luxury? No, don't.
I'm discount luxury.
Oh, that is right. You're TJ Maxx.
I'm
But
TJ
TJ Maxx, they get some luxury things, right?
They don't get LVMH.
They
but,
don't get
but
LVMH.
they'll get some Prada in,
I think I've seen like Montclair or something, right?
Yeah,
like, something like that.
Yeah,
level.
but
Okay.
that's still too expensive for me. But I'm more of like the Alice and Olivia kind of.
Okay.
This doesn't mean anything to you, does it?
Cool. I have no idea who that is, but nice. Hey, Alice. Hey, Olivia. All right. Coming up, we're going to talk to Dana Dory. I know who that is. Co-CIO over at Envestnet, as we continue to count you down to the closing bell. It's just about 14 minutes away. Stocks off the lows of the day, but still heading for a down week. This is The Close on Bloomberg.
I'm not particularly worried about what the market's thinking because, on the other hand, what the market also could be thinking is that this bill is going to create growth.
The Treasury Secretary of the United States, Scott Bessent, speaking a little bit earlier with David Weston right here on Bloomberg Television, a wide-ranging interview where, of course, he talked about the bond market, the tariffs, and what's going on in other parts of the pockets. And then David asked him about what he thought about the stock market. And he said, look, man, it's not my concern.
I don't believe it.
Yeah, I don't believe it either. But the market is down on the day and on the week here. And, of course, there has been a lot of concern right now about some of the trade and economic policies and how that feeds into the economy.
Yep. I guess you could say it could be worse. We were a lot lower in the futures market, but we're still down by 0.5%. But I want to point out a lot of that has to do with the technology sector. I mean, you have the NASDAQ 100 is down, S&P technology, worst performing sector in the S&P, and then you have the Mag 7 rolling over almost 3%, and the majority of that is going to be due to Apple. So it's not necessarily as broad-based as one may think.
Hey, but on the bright side, two of the best performing stocks right now in the steel and the nuclear power space.
Oh, yeah.
I bet you didn't have that on your bingo card. So there are opportunities out there, depending on where you are willing to look, as we count you down to the closing bells with just about 9 minutes to go. Let's bring Dana Dorio into the conversation, Co-Chief Investment Officer over at Envestnet. And Dana, let's talk about those potential opportunities out there. I think we've talked a lot about what's not working, but I am curious if you find any sort of real, impetus, if you will, to actually take risk or add to risk.
Well, we've been saying for a while now, I think, that if you haven't already invested internationally and diversified your portfolio internationally, no time like the present. I mean, we came into this year with, kind of over valuations that were probably overblown in the U.S., a storyline about U.S. exceptionalism, an expectation that we were going to continue to see dominance there. And then, of course, we had some news from the administration around tariffs that was much more than we expected. And all of a sudden, international stocks started to look good again. I mean, getting in front of these things, it's obviously very difficult, right? You're looking at a day, you just said it yourself, let's go nuclear, right? Like, trying to get in front of these individual industries and sectors is tough, but diversifying internationally, I think, is an easy way to at least put, a little bit of variability in the portfolio, protection in the portfolio. And
I wondered if that's going to accelerate, because there was a lot of talk about this idea of what's been happening in the U.S. over the last few months, and the idea of capital flight, the idea that people were meaningfully making reallocations outside of the U.S. And I think this morning was kind of a reminder that, okay, at least maybe have that as a possibility. I am curious, though, how far investors really want to take that. I mean, for all of the ructions going on here, we're still the world's largest economy. We are still the most liquid financial markets. And whatever issues we might be having in the government right now, that does not necessarily mean we have automatically sort of become just sort of, for the trash heap.
Yeah, no, 100%. I mean, look, this is all about, I will say hedging your bets, but I use that loosely as a term, right? Not literally a hedge, but if you're going to be in equity markets, diversification is the right play for most investors, right? If you're somebody who wants to concentrate in stocks and individual industries and individual sectors, you're making gambles, you're making bets, maybe you're doing fundamental analysis, you think you have some edge. My point, that's simply going to be extremely difficult to do. We don't just have a lot of volatility in returns right now. We have a lot of cross-sectional volatility because you never know what's coming the next day, right? It only takes what exists in the markets, the reality of markets in general, and multiplies that. And so if you're living in the markets, your best bet, an antidote to that type of risk, is just spread your bets because you don't know where it's going to be. But 100%, I want to validate your point. Look, we just had a really nice earnings season. The hard economic data in the U.S. still looks quite good. Now, the caveat, of course, is a lot of this is backward looking. A lot of this was taken prior to when, Liberation Day and the subsequent ups and downs, right? Maybe we're not going to do so many tariffs. The EU's not coming to the table. Maybe we are. So, that not all of that is worked in yet. So with that caveat, look, the hard data still looks pretty good. The Fed is still empowered not to actually lower rates. Why? Mm-hmm. Because the unemployment picture looks good. Inflation doesn't look bad.
He feels validated, by the way, just so you know, Dana. That was an important moment for him. Dana, okay, but take into account then what we saw with Apple today. So now we're in a world where we could have the president attack individual companies, not sectors, not necessarily countries, but companies. How do you think about that when you're trying to diversify?
I think it's a negotiating tactic, like everything else, right? I mean, I think to a certain extent, this administration wants to see movement on its priorities. It's willing to use tariffs. It's really found the perfect tool in tariffs, right? If you think about just how Trump wants to engage, he wants to be able to sort of have that cudgel to beat folks with. And tariffs are perfect because largely Congress has left it to presidencies to set tariff policy, and it can be done and undone on a pretty quick basis. And so it's the perfect kind of negotiating tool. I think what you're going to need to see is Apple make some movement, right? What Trump doesn't want and what will cause problems, as we can see with Harvard, is, a complete stiff arm. Now, that's not to say you should or should not, but that is what you're looking at, right? You're looking at an effort on his part to stake out an extreme case and then to see where they're going to go with that case, and are they going to move a little and give him a win, give him a narrative win.
Dana, before I let you go, what is the safety trade right now when you think about a portfolio construction?
Well, I'll tell you, I'll hesitate to call it a safety trade, but I will say more and more inquiries from the retail space around alternative opportunities. Some of these non-correlated to fixed income, non-correlated to equities. And really, as you see more and more innovation in the space around vehicles, I expect more and more, efforts to spread money into these places. Think about like real assets, right, or infrastructure that just kind of sit a little bit on the side of all of this.
All right, Dana. Dana D'Auria, have a wonderful weekend. Co-CIO over at Envestnet, helping us count you down to these closing bells here on this Friday afternoon. We still got just about 3 minutes to go before we get to those bells, Alex Steele. And the net effect of it all, we should point out, we came into today and it really looked like we were in for a massive sell-off after, of course, a couple of social media posts by the president, one on Apple, 25% tariffs potentially on iPhones if they don't reshore, and as much as 50% on the EU if they don't somehow strike a deal. We are off the lows of the day. So that's a good thing, but still in the red. Well,
also, we bounced off of the 200 and 100-day moving average, too, that I'm kind of making a little bit of a cross, which gives a bullish indicator. So I wonder if there's some technical patterns in play, too, especially as we head into that long holiday weekend. Yeah, and we should point out, too, of course, because of that long holiday weekend, volume is light. A lot of folks have gotten a jump start on the weekend here. So it'll be interesting to see when we come back on Tuesday. Remember, the markets are closed on this Monday. We should point out the bond market is already closed and the stock market set to shut down in just a couple Sell
minutes.
and may go away. Is that going to be what we talk about next week on Tuesday?
If you want.
Okay. We can sell and may and go away. Sure. Why not?
Okay. I want to talk more about nuclear power.
Yeah, we do.
I'm really into
Utilities, best performing sector in the S&P.
A full breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you through to that closing bell with a global simulcast. It starts right now. Scarlett Fu in the TV studio, Carol Massar and Tim Stenevik in our radio booth as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Right across the screen here on this Friday afternoon, right across the screen on a weekly basis as well, Carol Massar, the volume is light.
Yeah, and I feel like, absolutely. We're heading into a long holiday weekend, the official, start to the summer, you might say. So no surprise to see light volume. I think it's interesting, just kind of the headlines, though, the flurry of headlines. No, I thought it's supposed to be nice.
No. It rained earlier, so it's not going to rain.
I saw my weather app. It said Saturday and Sunday is going to be nice.
I heard that too.
Not nice enough for the beach, but not raining. How's that sound?
Do we have like a weather person here? We need like a Bloomberg.
Yeah, we do.
Own, like
it's
Willie
not going to rain. That's the weather report.
We have weather people. We have weather people.
All right.
We have weather people.
Yeah,
we are in a fishbowl.
Correction.
Anyway, it's kind of interesting. I feel like the Salesforce news, Informatica off and running, and then more news out of the White House, maybe about U.S. Steel and Nippon Steel. So, God, it's not quiet, guys.
It's really quiet because it's the Friday before a long weekend, and we know that people don't want to be too long or too short heading into any weekend these days because who knows what the president might say or tweet or post on social media. But maybe people got all their positions cleared on Wednesday when the 20-year bond auction didn't do well, and we saw stocks and bonds tumble. The S&P 500 losing 1.6% that day, and the next day, nothing much really happened.
I just want to point out my app on my iPhone here, Carol, says it's a high of 62. That's nice.
But does it show rain? She said the rain.
But no rain.
Where was that? Where was your iPhone made?
I don't know. How much is this app going to cost me?
Where was your phone made?
I'm going to hold on to this phone for like the next 20 years.
Oh my
All right, we get the closing bells in New York. Let's walk you through them here. Right across the screen, fractional losses across the board. The Dow Jones Industrial Average down about 250 points, or 0.6%. The S&P dropping about 0.7%. It is going to hold, though, right at that 5,800 level, 5802.83, though it takes a while for these numbers to settle. The NASDAQ Composite lower by about 189 points, or 1% even. And the Russell 2000, that's actually a relative outperformer on the day, only lower by 0.3%.
All right, quick check on the S&P 500, guys. Most names in the index to the downside. We've got 329 names losing ground on this Friday. 172, Scarlett, to the upside.
All right, let's take a look at our IMAP. 11 sectors in the S&P 500. 4 managed to finish higher. Unfortunately, they're all the smaller indexes, so that's why there's a lot of red on that screen. Infotech, communication services, and consumer discretionary. Those are the 3 sectors that the Mag 7 are distributed throughout, and they're down by at least 0.9%. Your better performing sectors, utilities. I heard Alex give them a shout out earlier. What does it say when utilities are the best performing sector on a day like today? A lot of movement to the defensive sectors.
No, I'm sorry. President Trump has signed executive orders on nuclear.
That too. 31 members of the S&P 500 utilities index are higher.
You can hear my snoring? Oh, okay.
Yeah, but there was some fundamental news here. Okay, whatever.
There was fundamental news. I mean, I got to tell you, I was changing my gainers to the last minute. Just ask our producer Meredith, because I was like, wait, can I do this? Can I do this? All right, Constellation Energy. Speaking of stuff out of the White House, you did see nuclear power stocks, thank you guys, soaring. We did see President Trump signing that executive order. So there was expectation, speculation earlier in the day. So a name like Constellation Energy, one of your top performers in the NASDAQ 100.
The one you chose?
Seriously?
Sorry.
Okay. You don't know what? You want to know why? All right. It's up 2% in today's session. Listen to this. Our Bloomberg Intelligence team, here's why I chose that one, noted that Constellation Energy is among the biggest beneficiaries of data center power demand and the Inflation Reduction Act, as it controls more than 20% of U.S. nuclear capacity. Over 85% of its annual generation is supported by nuclear production tax credits. That's why, Romy.
Take that.
Are you happy?
Yeah.
Okay. So from nuclear to solar we go. First, solar, guys, up about 1.3% in today's session. Again, we saw them selling off yesterday. Concerns about the spending tax bill would roll back clean energy initiatives and support. Well, some coming out today noting that maybe the House bill, some of those clean energy cuts may not actually fly. So you have that going on. Jefferies also raised its price target in First Solar to 157 from 127. First Solar closing above at 158 and change, but again, up 1.3%. 2 quick ads I did late in the day. You had Informatica rising in a big way, up 17% by the close, up as much as 28%. That's after that headline crossed on the Bloomberg. Salesforce said to be in talks to buy Informatica, so that's out there.
Well, that's buy them again, though, right? Remember they tried to do this about a year ago, and then they kind of walked, I think it was Informatica maybe walked away, or I'm not quite sure what happened there. Kind of interesting to see that back on the table.
Yeah, you're right. Okay, good stuff. Good stuff. Good ad, Romaine, there. Nice. Thank you so much for that.
I love when you patronize me.
I love to patronize you. And then you'll say President Trump backing what's said to be a partnership, although we don't know exactly what this means, of U.S. Steel and Nippon Steel. And so you have U.S. Steel up about 21%. What?
No. President Trump might have different ideas when he says
Scarlett,
partnerships.
Can you stop interrupting Carol, please?
Oh, I value that. Come on.
Scarlett can interrupt me anytime. Just saying. Go ahead, Tim.
Oh, okay. Let's look at shares of Apple. They fell today by 3%. It's actually down for an 8th day in a row. Fell as much as 4% earlier in the session, but managed to close off its lows. The president pressuring Apple to manufacture its iPhones in the U.S. It threatens a tariff of 25% if they don't comply. The supply chain for iPhones are concentrated in China. Moving production to the U.S. would be a very difficult thing to do. Our own Mark Gurman has reported on this extensively. My favorite anecdote that he shared via his reporting was that it would basically be like taking the entire city of Boston and having them stop what they're doing to manufacture iPhones, everybody in the city. That's what the scale is like in different parts of China where they manufacture these products. Down 3% on the day today. Booz Allen Hamilton really fell in today's session. Earlier fell as much as 19.4%, closed down 16.5%. That was the worst close going back to 2017, or worst single day, I should say, going back to 2017. At one point, fell the most ever on record. The company said it's going to cut about 7% of its close to 36,000 person workforce.
Yeah.
This is wild. I didn't know this. They get almost all of their revenue from the U.S. government.
Yeah, I've been following this company for a long time. And it's just, I mean, that's fine. But it's like, why is it that some of the defense contractors and the other tech contractors are doing okay, but this company, which is right in the middle of that sweet spot, it's not like they're just, just selling random stuff. I mean, this is pretty high-tech stuff.
It is, but, maybe the concentration of, those defense, I don't know. I mean, look, I don't know the answer to this. And I think it caught investors off guard as well. And that's why shares fell so much today. Finally, I do want to end with Salesforce. Carol talked about Informatica shares rising. As soon as we reported that news on the potential acquisition, we did see shares of Salesforce fall today. Fell at the end of the day by 3.6%.
All right, taking a look at the bond market. Today wasn't that interesting, but it's really over the week that we got some real action. So the long end flat on the day. We were selling off a little bit earlier when equities were also trading. We were buying a little bit. Yields were actually lower when equities were selling off, but we reversed that. But the week, quite interesting. 30-year at one point hit the highest since 2007 and breached the cycle high of 5.17%, but then fell back from that. You also saw the 530 curve, the steepest since 2021. So clearly the stressors are going to be felt in that back end.
All right, guys, it's the official start to summer, right? Memorial Day weekend.
Sure.
And it's
like 40 degrees, but whatever.
All right. Put a sweater on. Hey, but it's also the official start to kind of the summer blockbusters, and the Mission Impossible series has got a new movie coming out. It's already out and hitting theaters today.
Have you seen this, Alex?
No, I literally bought my tickets while you guys were doing winners and losers.
Well, apparently there's a line in the movie about...
She's actually not lying.
I'm literally not lying.
Rude.
All right. So there's a line in the movie about giving, Tom Cruise, his character, an aircraft carrier. And it turns out the U.S. Navy and Air Force Special Operations actually gave him an aircraft carrier and the team to actually film on.
Nothing new when it comes to sort of the marriage between Hollywood or the government's support of Hollywood. The Pentagon has a long history of being a supporting character. Famously, the Hunt for Red October going back to 1990.
Yes. Great movie.
Top Gun.
That was a huge one.
Top Gun 2, which is, the Return of Maverick.
I think it's the 31st anniversary of Top Gun this month, by the way.
Really?
I believe, yeah.
Feeling
I get my
old.
math right.
Yeah, I know. Pirates of the Caribbean.
Really? Wait, what?
Really?
What? Wow, that didn't do anything.
Right.
Little
That landed not so well.
What was that promoting?
Wait, the Pentagon, the U.S. military played a role in...
I mean, there were ships involved, right? I don't know.
I thought we were talking about Memorial Day movies.
Oh,
okay.
No, you're too busy buying your tickets. You got to pay attention.
Are
we all going to go see Mission Impossible? Who saw it? You saw it, Scarlett?
I saw the first.
I saw part one, but half of part one, up until the point where they start explaining things. Then I lost interest.
Mission Impossible?
This actually tracks for me.
Okay, what about like parts, the other parts?
Oh, no. Part one of the latest version, Dead Reckoning. This is part two of Dead Reckoning.
Clearly, Romaine has not seen it.
He doesn't know.
I don't know what's I have
I've
no
seen it
idea
a million
what's going on.
times.
Oh, okay.
Yes.
Sorry.
I'm going to go see it
derailed this
tomorrow.
conversation.
Tomorrow at 3. You definitely did. Tomorrow at 3 and things.
Anybody else go to the movie?
Well, which part? Is it part 1 or part 2?
Part 2. This is the
part
end.
2.
This is the for real final
But I haven't
reckoning.
seen part 1.
Then you can't go.
All right, this is like who's on first.
Ethan Hunt will save the day.
We're never going to get out of this.
Alert.
All right, good luck at the movies, Alex. Tell us. She can report back on Monday. All right, guys, have a good and safe
Lilo
weekend.
and Stitch Part 6.
Have a good and safe cold weekend. All right, you're done. You're so done. You're so done. That's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Alex is heading out to the movies or somewhere else. And of course, Romaine and Scarlett finishing up on TV. Tim and I right here on Bloomberg Business Week Daily. Guys, see you on Monday. Tuesday.
That went well.
All right, we got a lot more business to cover here on Bloomberg Television. Of course, the big news coming into today was concerns here about Apple and the escalating pressure from the Trump administration to reshore production of its iPhones and other devices. We're a conversation up ahead with Gene Munster, managing partner at Deepwater Asset Management. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. We're closing out a week. Volume is light, of course, heading into a holiday weekend here in the United States of America. Memorial Day being celebrated on Monday, so markets will be closed. We should point out the bond market closed early today. The stock market, though, just closed a few minutes ago, and it was down 0.7% on the S&P 500, a weekly loss of more than 2%. And a lot of that, of course, was precipitated by a reigniting of some of the trade war rhetoric, both around Apple and the EU. We'll get to those discussions in just a moment. The Mag 7 really dragged down by some of those headlines. Bitcoin also taking a little bit of a leg lower, but still holding above 100,000. But one big bright spot out there, if you came in today and said that, well, nuclear stocks would be the big outperformer, well, I would not have believed you, Scarlett.
Yeah, well, you were right, and they were right. And let's take a look. Oklo, one of the big nuclear power stocks, on the move, higher by 23%. President Trump signed multiple executive orders to jumpstart production of nuclear power in the U.S., mainly by easing the regulatory approval process for new reactors. So Oklo not the only one gaining, but clearly it was a standout. Apple down about 3%. It was actually an eighth day of losses, and the stock is now hovering at a one-month low. President Trump, of course, threatening to impose 25% tariffs on the company. This is the first indication of tariff threats on an individual company unless Apple starts building its iPhones in the U.S. So our top story this hour really summarizes all of that. Trade concerns are taking center stage again after a fairly quiet 2 weeks on that front. President Trump threatening a 50% tariff on the European Union starting June 1st, accusing the bloc of slow-walking trade negotiations. Separately, he said that potential 25% tariff on Apple, that would apply to devices from Samsung Electronics, as well as any other smartphone maker, to be imposed by the end of June. He dismissed concerns that those moves would lead to higher price tags for consumers, insisting that foreign countries and companies could absorb most of the cost. Romaine?
Yeah, and of course, that trade brinkmanship, really a reminder here for a lot of investors that there still is risk out there. You saw a retrenchment, looking back towards defensive sectors, looking back towards value. As we break down what actually moved the markets on the day and on the week, let's bring Chris Cain into the conversation for our Factor Friday. Of course, he is a Bloomberg Intelligence market strategist. And let's start with that value trade, because I thought that had been doing well. Just kind of talk about sort of, I guess, how it's been performing, particularly relative to growth or at least more expensive stocks.
It hasn't been performing very well. I mean, it has fits and starts, but generally it's been the worst performing factor of the four main factors we covered this year. It was also the worst performer last year. One thing about that, or a result of that, though, is that cheap stocks are now way cheaper than expensive stocks. If you look at a price-to-sales basis, it's trading at just 8.8% on a price-to-sales basis, cheap versus expensive. That's one of the lowest valuation relative ratios over the last 25 years. Wow. It's actually a second percentile result over the last 25 years, basically one of the cheapest levels we've seen on a relative basis. So potentially could be set up well here.
Was that because of like a price run up recently, or just?
It's just because value has really lagged. Value has really lagged, and it's been 18 months now of pretty consistent lagging. So it's just getting cheaper and cheaper.
All right, cheaper, getting cheaper. Have you found any significance in the valuations gap historically between cheap and expensive stocks?
We have, yeah, and this is where it gets pretty compelling. So we looked at this valuation gap over the last 25 years. Bucketed it into 5 different groups, and then looked at the average forward long-short value factor return after those observations. And what you see is what you would expect to see. When cheap stocks are way cheaper than expensive, it averages about 20% return over the next year. When cheap stocks are not as cheap versus expensive in that highest quintile, it averages actually minus 5% over the next year. The thing about this signal, though, is it's a relatively long-term signal. When you do this regression over the next month or the next quarter, you don't see much of a relationship. But I think patient investors here, patient value investors, could potentially be rewarded.
Okay, so there is value to be found. I guess one bugaboo in that is also the issue of profitability and how that holds up in economic conditions.
Yeah, Romaine. I mean, it's kind of a good news, bad news scenario here. So good news, value is very cheap. Bad news is the fundamentals are deteriorating, specifically profitability, like you said. Like we look at just the high value or cheap cohort, went from 20% ROE down to 8% ROE over the last, call it 3 years. It's now 6.5 percentage points on an ROE basis below expensive stocks. Again, one of the widest spreads we've seen. So they're cheap, but their fundamentals are deteriorating. So it's a kind of a give and take.
All right, good stuff. Chris Cain of Bloomberg Intelligence.
Impossible 2?
He's obsessed with this, by
the way.
Because
I just found out
there's
a part 2 to to what, the sixth Mission Impossible movie? Or
I haven't kept count, but Dead Reckoning is the most recent one, but they had to break it up into 2 parts. So part 1 was last summer, part 2
which
was
I just
summer.
learned like 10 minutes.
I always got lost in those movies, to be honest.
Yeah, you're my
I mean,
spirit.
the plot's kind of the same, though, right? And he's going to save the day.
We got to give it another try.
He's going to win.
Yeah,
Ethan Hunt wins in the end.
Yeah.
Sorry, spoiler alert. All right, much more coming up on Bloomberg Markets in the 4 p.m. hour. Trump's tariff threats are rattling markets. We're going to have more on that next and look at the political angle. This is The Close on Bloomberg.
Earnings season is here.
Earnings, the hot topic of conversation.
It's going to be a lot of fireworks.
Pretty astonishing moment in time in the earnings context.
Bloomberg is first to break the numbers.
Goldman Sachs, JP Morgan, Morgan Stanley.
Booking, Airbnb.
Meta, Microsoft, Qualcomm.
There's a lot to talk about here.
With the smartest insights.
We're not seeing dramatic weakness.
It has been an incredible period of time from a trading perspective.
We feel really good about the market share trajectory.
Continuing coverage on Bloomberg. Context changes everything.
And I feel like earnings season really comes to a close or a climaxes on Wednesday when NVIDIA reports results after the market close. We'll have that all covered here on The Close. Meantime, U.S. Treasury Secretary Scott Bessent stopped by Bloomberg headquarters and sat down with our David Weston for a wide-ranging 30-minute conversation. Here's part of what they discussed.
We have substantial revenue coming in now, and there is at some point there's an equilibrium rate, what's called a Laffer curve for tariffs. And I think we will reach that rate. The other thing that's happening is a lot of there are tariff barriers or non-tariff trade barriers. A lot of these non-tariff trade barriers are coming down, so friction's decreasing there. And again, because we don't know where these tariff negotiations are going to end up, they won't end up being scored. But it's several $100 million a year, several $100 billion a year of revenue that will be used. For every $100 billion, that's $100 billion less of bonds that Treasury has to issue.
When you talk about uncertainty and getting more certainty because of the tax bill, some of the uncertainty, a lot of it is because of tariffs right now, because we're not exactly sure where we're going to end up. Do you have a sense when the economic community, the business community, will get better certainty on tariffs?
Well, we've done the 90-day pause. As I've mentioned several times, we have 18 important trading partners. So what everyone should really focus on are those. We've done a deal with the UK. My sense is over the next couple of weeks, we're going to have several large deals announced. We have put a pause and a 90-day pause with China. I expect that we will be negotiating in person with them again. And then the president today, when we initiated the pause and the 10% are moving down from the April 2nd rate to the 10% level was contingent on countries or trading blocs coming and negotiating in good faith. And I think the president was getting frustrated with the EU. The problem with EU, I've said several times, they have a collective action problem. There are 27 countries. They all have different needs. The Germans, they are interested in cars, the French in agriculture. And then you have Brussels negotiating with them.
And that is the Treasury Secretary of the United States, Scott Bessent, speaking a little bit earlier with David Weston right here on Bloomberg. And it was kind of interesting, Scarlett. We talk about this idea of the trade war being sort of part of what he says, of course, is a more holistic approach, that three-legged stool. Mm-hmm. Of course, it's going to encompass, tax cuts and deregulation and other things. He was asked whether, what he thought about the stock market, and he was kind of dismissive, saying that's not really where his mind is at right now. He's much more focused on the economy and sort of keeping things on track.
Well, as long as the stock market is kind of holding up, you don't really have to think about it. It's when it throws a tantrum that they start having to focus on it.
Yeah, absolutely. Well, speaking of which here, of course, he was asked extensively here about the trade fight going on right now between the U.S. and EU. The president of the United States this morning firing off a missive on social media saying the tariffs on the European Union could go up to 50% as a baseline. Kailey Leinz joins us right now, co-host of Bloomberg's Balance of Power, to talk a little bit more about this. And I thought it was interesting, the timing of it, of course, because it came just before U.S. and EU trade chiefs were supposed to meet here. And you heard Scott Bessent's reaction to that. The president a little bit later in the day saying that basically, I don't care too much about making a deal with the European Union. Does he?
Yeah, the president maintains that the European Union was set up entirely in part to be unfair to the United States on trade. That is the president's fundamental position here. And he says that he's not really looking to make a deal with Europe. When he was asked by a reporter in the Oval Office if there was a way that Europe could negotiate prior to this June 1st deadline that he laid out today, he said, we'll see. But then went on to say, we're not looking for a deal. We've set the deal, and the deal is 50%. That said, we know that the president, when it comes to these tariff threats, has had a tendency to walk them back. So by no means is this a guarantee that this levy will be placed on all European goods next Sunday. But clearly, it is a sign that the conversations with the European Union are not progressing in the way the administration hoped they would, especially in comparison to some other countries we're actively negotiating.
All right. So we're all looking to June 1st now, which is when those are supposed to go into effect. It was kind of while that sort of hurt the market did get a little bit of help by the White House today. The president was actually in the Oval Office signing an order on nuclear power to actually accelerate the construction of nuclear plants in this country. And we saw a lot of those stocks, including Oklo, rally hard.
Yeah, we certainly did. Of course, one of President Trump's main objectives in terms of his economic plan, in addition to tariffs and what he wants to do on tax policy, is deregulation. And that is now applying in the nuclear energy space as well, as he would like to see the nuclear energy capacity of the United States potentially quadruple by 2030, with a number of new plants coming online. All of it aimed, as we heard him and the Interior Secretary Doug Burgum talking about in the Oval today, at really trying to ramp up energy production to fuel what is expected to be incredibly strong energy demand from things like AI data centers and the like that are going to require more capacity and more power. So that is something that the president is looking to here. That said, given the acceleration of the timeline, there have been some questions around whether this could create security and safety risk. He largely, though, brushed aside any safety concerns when questioned by reporters about that this afternoon.
Kailey, I want to get your take on what the president is saying with regards to a big move in the steel sector. The president backing a partnership between U.S. Steel and Nippon Steel. Of course, Nippon had made a bid for U.S. Steel that in the end, the U.S. government under Joe Biden had blocked. And when the initial plans of a partnership first appeared, it seemed to be a proposal that President Trump came up with that both companies seemed to be surprised by.
Yeah, well, President Trump making it official today after, mind you, he received the report back from CFIUS, the Committee on Foreign Investment into the United States, that looked specifically at this deal, which was supposed to be a $14 billion purchase Nippon Steel wanted to make to acquire U.S. Steel outright. President Trump saying U.S. Steel will remain in U.S. hands, and instead that $14 billion will be put into the U.S. economy in the form of this partnership and investments Nippon will make in steel capacity here in the U.S. The president saying this will create 70,000 jobs. It's not totally clear what this will look like, but we could get some further detail from President Trump next Friday. He says he'll be in Pittsburgh at U.S. Steel to talk about this, but clearly a bit of a departure from the Biden administration that said for national security reasons, we want U.S. Steel to remain wholly U.S. owned. They didn't really want Nippon to have anything to do with this, but President Trump signaling openness to what he's describing as a partnership.
He's not just in Pittsburgh. He said a steel rally, Scarlett.
Well, there you go. He loves his rallies. Kailey, when it comes down to it, how much of this was a sticking point between the U.S. and Japan in their trade talks? Because Japan was pretty early in approaching the U.S. to discuss a trade deal, and nothing really came out of it in the end.
Well, actually, Japanese negotiators were negotiating with the U.S. today, Scarlett, which makes this timing incredibly interesting that you have against the backdrop of those wider conversations about lowering tariff and non-tariff barriers between the U.S. and Japan, that these Nippon conversations were also happening, keeping in mind that when initially the Biden administration moved to block U.S. Steel, there was many questions around what national security risk a U.S. ally, one that is very close both for defense purposes and economic reasons, would actually pose. And you're seeing that economic relationship in terms of trade still in focus for this administration.
All right, Bloomberg Balance of Power co-host Kailey Leinz. Make sure to tune into her and Joe Matthew at the top of the next hour. Coming up, Apple facing escalating pressure from the president. It's trading at a one-month low. We'll discuss with Gene Munster of Deepwater Asset Management. This is The Close on Bloomberg. Apple facing escalating pressure from President Trump, who is threatening tariffs on the company if iPhones sold in the U.S. aren't made inside the country. Gene Munster is managing partner at Deepwater Asset Management, and he joins us now. Gene, good to speak with you. How much of a surprise do you think this is for Apple and Tim Cook? Because we know that they had been in discussions with President Trump during the first Trump administration and gotten an exclusion. And there's been hints dropped along the way this time around that things were not going as well. The president saying this month that he had a little problem with Tim Cook.
I think it is a surprise. You talked about this 8 years of almost this partnership that's been between Apple and Trump. Apple, of course, being the global symbol of innovation, and Trump recognizing that and really boasting, of course, in the first round of tariffs 8 years ago, Apple was spared from those largely, and the expectation was a lot of that would continue. And so this is a noteworthy shift in terms of how the White House is thinking about Apple. And I think it comes in part because Trump has had some political momentum over the last 3 weeks, which gives him an opportunity to kind of negotiate essentially with business leaders through his commentary in other countries. And so I think that's one piece, is he's using this Apple commentary as a simple way to talk about even higher, moving tariffs even higher after that 10% kind of benchmark that was set with the UK. So I think that's one piece to what's going on. Of course, you can't tariff one country. You have to tariff, you can't tariff a specific company, you tariff a product category.
Yeah.
And so I think that dynamic was pretty unique. And then separately, I think Trump very much wants to bring manufacturing of things like pharma and advanced electronics into the U.S. because of just a change in their globalization act. So I think he really wants to encourage not just Apple, but other companies to do just that.
Right. So from what I'm hearing, you think in a way, it's the president flexing after a pretty successful overseas trip. Is this a way also for the president to get Tim Cook to pressure China to make certain concessions or make more concessions as U.S. and Chinese negotiators figure out the trade situation there?
So the truth lies below the surface, and I talked about some topics that are at the top of the surface, but you are correct to mention is that there's another piece of this too, is that by asking him to bring more stuff, Tim Cook to bring more manufacturing to the U.S., that could help with the negotiations with China because, of course, there's a lot of Chinese that are employed, call it 1 million directly with manufacturing Apple devices. But when you look at the broader ecosystem, it's multiple times higher than that. So China's a big country, but Apple still matters when it comes to their economy. And I think that is another piece that could be below the surface. I do want to mention, too, about just the tariff piece. I think there's an important piece that's been largely missed today in terms of this 25% tariff. I want to make sure we cover this, is that the sense is that means that the price of iPhones are going to go up by 25%. And I recently talked to a high-level former U.S. trade official, and just want to be clear is that the tariff is not on the retail price, it is on the cost coming into the country. So what that kind of means is it's going to be more like a 14% price increase. So I just want to make sure that people are aware in terms of the headline of that 25%, that stinging headline. In reality, it's not as bad as that headline would suggest.
Yeah, and that's a good point, Gene. I am curious, though, if we do get to a point where that cost does actually become real and not just theoretical, what does that mean for the bottom line? Are you modeling in any sort of material decrease in sales, and are you modeling any sort of decrease in profitability?
And I am modeling for that. And just to put some perspective on it, the Street's looking for about 5% growth for iPhones for this year. And I'm at 4%, so a slight discount. But also my margins are a little bit lower. So right now the Street's generally at about 44% on the gross margin side. And if you assume that there's a 25% tariff and Apple basically takes the majority of that hit, that margin would come to 41%. And so that's the delta there, 7% below where the Street's at right now. So there is some nagging here. I think that ultimately the mystery around where these numbers are going is probably more painful than the actual bite of the numbers.
Yeah.
That's, of course, what stung the stock on the last earnings report. Great earnings report, great outlook for June,
Yeah.
but investors still are concerned about the back half.
Can we just spend a couple minutes, though, just talking about maybe the possibility of actually trying to reshore some of this stuff? Someone reminded me earlier that Apple actually tried this maybe about 10 years or so with the iMac, and apparently did not go very well, primarily because of a lot of the issues that we talk about with the iPhone, the lack of expertise here. Obviously, you have a job environment here that's a lot different. You can't push the workers to do the same thing here that you maybe can do in China or Vietnam, Indonesia. Is there, though, a case to be made that with the advances in automation and some of the other things that maybe take some of the human equation out, that there could be some chunk of that capacity that maybe could come back here to the United States?
The simple answer is yes. I would expect that the upshoot of all of this is going to be that you're going to see a small amount of iPhones being made in the U.S. I think that piece around the modernization, around robotics, all that can help, but still is not going to solve the challenge of the price of an iPhone going up 2-3x if it was made in the U.S. And so in order for that to happen, that really needs Congress to do something like happened with the CHIPS Act. That, of course, has had a big impact in terms of how NVIDIA and TSMC have been investing more into advanced chips in the U.S. We need to see the same thing when it comes to manufacturing devices. And what that kind of comes down to is effectively tax dollars going to companies like Apple and other people who are building this critical technology for them to basically burden or to share some of that burden of the cost. And so I think that the answer is we're going to see a little bit more, but to see it in earnest, it's going to take a much bigger effort by Congress and the president to do just that.
Well, it'll be interesting to see, too, I mean, how Tim Cook navigates this. Of course, he's been kind of the ultimate diplomat, not only during this administration, but the previous ones as well. So I guess if you're an investor, I think you would say maybe you do bet, if not on Apple, certainly on Tim Cook. Gene, we got to leave it there. Gene Munster, managing partner. Absolutely, over at Deepwater Asset Management. Have a wonderful weekend. Of course, a closer look at Apple, and you go back to the founding of that company back in the 1970s of Steve Jobs and Steve Wozniak. Ronald Payne, can't forget about him as well. We actually want to push ahead now to maybe what could potentially be sort of the next big company, the next big companies of the future. That is our segment right now, where we highlight the entrepreneurs and trendsetters moving the needle in the markets, in technology, and of course in the money needed to raise in order to finance those dreams. Today we're looking at a company called ESAI. It's an AI platform that helps students navigate the college admissions process. The company just received an investment of $250,000 from Mark Cuban after a very stunning appearance on the show Shark Tank. I'm pleased to say that the founder of ESAI joins us here in Studio 2, Julia Dixon. Great to see you, Julia.
Great to be here. Thank you both for having me.
Not as quite as exciting as a Shark Tank, I'm sure. What was that moment like? Because, I mean, I watch this show a lot, and I'm always curious as to, after someone finally convinces one of the sharks to take an investment in them, what comes next? I mean, you walk off stage, the cameras are off. All of a sudden, the whole world is going to see and hear about you. Were you prepared for the potential increase in attention that ESAI was about to get?
It was pretty surreal.
Yeah.
There was a lot to do to prepare. We had a lot of our success beforehand from TikTok, so we were used to reaching some pretty big audiences, but we never had quite a singular spike like when the Shark Tank episode aired. So we had to make sure we were ready for potentially tens of thousands of people to come on the site at once, and that's exactly what happened. It was pretty crazy.
And you mentioned TikTok. I mean, you kind of got your start doing student counseling. You sort of leveraged that into social media and leveraged that into an actual business. Just kind of explain exactly what this is supposed to do, because it's not so much like writing a paper for me or an application for me.
Right.
It is basically counseling, right?
Correct. So I used to be a college admissions advisor, and it's a $3 billion industry in the U.S. People who help students and families navigate the very complex and competitive college admissions process. And I used to do that work, and it really favors people who can afford this elite level support, which can cost hundreds of dollars an hour, sometimes hundreds of thousands of dollars for a 4-year package for people who get guidance throughout high school. So I wanted to be able to bring more of that individualized support for more people and at a lower cost. I thought AI could be a really good use case here. It can give the same level of customization. It can help people find unique skills and passions in their story they might not have noticed otherwise, and it can connect the dots between the student stories and what schools are looking for. So that's the thesis we've been working off of, and we use TikTok to kind of help kids see how they can tell a unique story, and we want to help them do it.
So the best college admission essays are built around personal insights, personal realization, aha moments, and meaning rather than information that's already available in other parts of the application, like your credentials or academic achievements, sports, extracurriculars. Aren't students at risk, therefore, of being advised by the algorithm to write formulaic essays then that sound, familiar and similar to each other?
It's a great question, and you're completely right. I always tell students the point of a college essay is not to repeat your resume or things that are already listed elsewhere on your application, but instead to tell a really good story. What are the intangible parts of you, your sense of humor, your cultural background, your family life that are going to make an admissions officer say, wow, I really like this kid and I really want them on our campus. And what we do on SAI is never outsource student writing or create anything that's meant to be submitted as final content that could sound formulaic or like other people's essays, to your points. But instead we tried to find out what is the thing about you that only you could say, that even your other classmates and closest friends couldn't quite say because it's uniquely your story. So we ask prompts that are very Gen Z facing, like what do you and your friends rant about for hours, or what's something that makes you really feel like yourself. And we try to ask interesting questions that get kids thinking about themselves differently, and then we help them connect the dots why this is relevant to a college. So by doing a lot of self-discovery with AI, we make sure that you're getting to a story that's uniquely you and not overly formulaic.
I see, you're guiding them essentially.
Yeah.
So the original platform of SAI was free to use with some optional upgrades.
Correct.
Talk about the business model now. Is it still free? What costs money? What are people paying up for? Is this a freemium business model?
It's a freemium model. So there is a version of SAI that's completely free, and some of our tools can be used at no cost to students or families. We have a pro version. There's weekly, monthly, and annual plans. It's as low as $50 a month compared to the average college tutor who charges about $200 to $300 an hour. We like to think that's a much more accessible cost, but we do also work with organizations across the country like American Student Assistance, and we work with collegeadvisor.com and folks who can offer students access to our platform at no cost to them or as an add-on to a service they're already paying for. So we have a bit of a dual business model in that way, but our goal is to reach as many students as possible at as accessible of a cost to them.
Okay, so now this is where I get to play shark. So like, what's the total addressable market that you're going for here?
Yeah, I mean, like I said, the college advising industry is already very big in the U.S., but I think there's an even wider market if we could reach a wider population of high school students, not just those who can afford a very high price point of college advisors. And there's an opportunity here to create a wedge, not only into college admissions, which is maybe the first time teenagers have to really build a professional brand and think about their long-term goals, but could we be a place where you start that story and we tell it with them long-term?
And the competition right now and the potential for maybe new startups to come after you, you worry about that?
There's definitely always new startups coming out there. We were definitely among the first to do an AI native college admissions platform, and I think why we've been able to get a good foot in the door is because we've built a really strong brand and a really great community on TikTok. I think there's definitely an opportunity right now to help Gen Z build soft skills and tell their professional story in a world where the human qualities about you and things that really can't be automated are extra important right now. So I think we will see a lot more companies in this space, but by capturing attention at this sort of first real pain point in personal branding and telling your story, I'm hoping we can capture attention early.
When you went in there, did you want Mark Cuban?
I was very open to other offers. I was ready to listen to what everyone had to say, but you could probably tell from my pitch. We used Mark Cuban's picture from high school as our example student, Mark C. So I've been following Mark for a long time. I know he's interested in machine learning and AI. He has his own foundation to help kids access education. He seemed like the perfect partner for us, and I was hopeful that he would see the vision, and luckily he did. From the moment I stepped in the room, I could feel that he liked the story we were telling, and I'm really glad that he bit.
You did your homework.
Yes, definitely.
Julia Dixon, great stuff. Thank you so much for joining us, the founder of SAI.
Thank you.
All right, let's take a look at how markets closed on the day before the long weekend. You had a bit of a risk-off day with the S&P 500 losing ground here by 0.7%, about 2/3 actually. And it was risk-off, so treasuries were a haven on the day. You have the 10-year yield coming down to 4.51%. The dollar, however, weaker by 0.8%, plumbing those lows that we've seen for a while now. And gold futures climbing almost 2%. This is The Close on Bloomberg. Gearing up for Memorial Day this weekend with record travel expected for the holiday. AAA is projecting more than 45 million people to hit the road through Monday. Joining us now to discuss is Brian Kelly, founder of The Points Guy. And Brian, your survey shows that when we say hitting the road, it means literally staying within the country, within the borders of the U.S., as opposed to flying and leaving the country and going overseas.
Yeah, I mean, certainly there are international travelers happening, but what we're seeing is a lot more people hitting the roads. Gas prices are down about 20% from last year, hovering around $3 a gallon. And, I think a lot of people booked their international trips in March and April. And with all the market fluctuations, I think a lot of people said, we still want to travel, but let's stay closer to home.
So what does that mean in terms of people who want to pay through points as opposed to pay up in cash for their tickets? Have the airlines, the programs adjusted for that?
Yeah, so interestingly, across the board, airfare this summer is down around 8%, which is pretty significant, and around 5% using your points. We actually worked with a company called PointsPath to look at how much airlines were charging in both cash and points this summer versus last summer. So, yesterday was the fourth busiest day ever for the TSA, but my hunch is that the airlines have had to discount, or actually I know the airlines have had to discount to get people flying. So it's still going to be a busy travel season, but the airlines are not making the margin that they did the last several summers.
So where are people going, Brian? I mean, you guys track this data. I mean, okay, if I want to stay here in the United States, I mean, I know it's still late for me to be making Memorial Day plans, but where's everybody going?
Yeah, Orlando and Vegas are big hotspots. And internationally, we actually, Vancouver was a top 5 city this year. And that's where you can actually get a great deal because we've seen so many Canadians kind of boycott travel to the US. That is the one constant trend we're seeing. Airfare to Toronto, Vancouver is down 15% over last year. So for Americans who don't want to go to Europe but still want to have something a little bit different, we are seeing the trend of Canada, and also Alaskan cruises are up big this year as well.
Oh, wow. Yeah. Well, Vancouver, I love Vancouver. That'd be great to go to. And now that maybe it's a little bit cheaper. What about inbound travel? Are you seeing a significant decrease in inbound travel from international travelers to the U.S.?
Yeah, the last time we chatted about a month ago, there were all these numbers that were quite alarming about the decrease in foreign travelers. And, there was a lot of thought, could this be due to, our immigration policies? But the biggest factor there was the Easter holiday falling in April this year versus March of last year. That was accounting for most of that European drop-off. There was a small drop-off in Europeans coming to the U.S., but that travel is still holding pretty strong. So, strong U.S. demand. And I will say, though, that there is a little bit of a drop-off. I'm seeing incredible award availability this summer for those still looking to go to Europe. If you haven't booked your Greece trip, London, the U.S. dollar is still really strong. So I was just looking, there's award availability on American Airlines. They actually have their brand new 787 suite. In August, you can find their base level award availability, which I haven't seen for years. American's also running a fare sale using a point sale as low as 5,000 points, and that's for all of August and September. So think about that. One of the world's largest airlines is starting the busy summer travel season off with an award sale.
Yeah, the fact that there's a sale and it's an award sale is kind of boggles the mind. Brian, I want to get your take on this disruption that we've seen with flights in and out of Newark Airport. They've, of course, suffered outages and they've had to reduce the number of flights, and it's really affected airlines like United. What does that mean for traffic at the other New York City metro areas, and has it increased ticket prices to fly into the New York City area because you have to avoid Newark?
Yeah, the Newark numbers are definitely down. We don't have the official numbers yet. And all my sources at the airline say, yeah, JFK and LaGuardia are up. But, it's really a shifting. Philadelphia is also picking up quite a bit of that Newark traffic. But still, quite a few people are still traveling in and out of Newark. It's kind of a perfect storm happening there with their air traffic issues and also one of their runways down for scheduled maintenance. That runway should be back online in the middle of June. So that should ease things up. But Newark is for sure not out of the woods yet. And I would like to remind people, it is still safe to fly in and out of Newark, but most people are avoiding it because of the potential for cancellations. So, for people always asking me, should I cancel and rebook for thousands more and have to connect out of LaGuardia instead? I would probably not.
Yeah, well said. And of course, it's not a safety issue for a lot of us. It is just trying to get to where we need to go fast. Brian, always great getting your insights here, and I hope you have a relaxing holiday weekend if you can. Brian Kelly, of course, is the founder of The Point Sky.
And he was actually joining us from New Hope, Pennsylvania, as opposed to any of the fancy locations that he is often at when we speak with him, because he doesn't need to travel on the busiest travel weekend of the year.
Yeah. Well, New Hope has gotten a little fancy. It's not necessarily the rural outback that it used to be. Have you been out there? I think it's like celebrities just like milling around all there. You might run into, who knows. Anyway, stick around. We're going to set you up for what to watch over the next week. This is Bloomberg.
Live there, by the way.
All right, let's set you up for the week ahead, and we start out on Monday, which is actually a holiday here in the United States. All the financial markets here will be closed.
Memorial Day here in the U.S., but ironically, the UK market is also closed. Not Memorial Day there, though.
They have something called a bank holiday, which is recognized by all the territories except for the Republic of Ireland.
What, the banks just take off that day?
For some reason, I guess so. Anyway, Tuesday when markets open back up here in the United States, we are going to have some economic data to parse.
Yeah, we have U.S. durable goods, so that's a hard data point. Consumer confidence, which is soft data, but we'll wait to see whether the hard data continues to hold up as it has been.
And next week is actually going to be the last really big week for earnings here in the U.S. On Tuesday, we get AutoZone, Okta, Xiaomi out of China. But Wednesday, that's going to be the big one.
Yeah, Wednesday we have NVIDIA, and it's set to post revenue growth of 67%, which actually is the lowest since first quarter of 2024, before the whole AI hype really began.
We're also going to get earnings out of Macy's, Dick's, Abercrombie, so a big retail focus as well. Salesforce also going to be reporting. I want to flip to Thursday, though, because you take a look at some of those names at the bottom there: Best Buy, Kohl's, Foot Locker, Burlington, Costco, Gap. That's a tariff story, right?
That is a tariff story.
Yeah.
American Eagle, for instance, we already heard from them. They're going to withdraw their full year guidance. It's pretty clear that they don't have that much visibility.
And then on Friday, we're going to get a read on inflation in the United States. Personal income and spending numbers will be out. We'll have full coverage of that right here on Bloomberg. Tune in next week to The Close. This is Bloomberg.